Mike Santomassimo. Mike, welcome back. Nice to see you.
Hey, Sarah. Thanks for having me.
So clear, the market's taking it well, and it looks like aside from some of those litigation costs, it was a beat on the top and bottom line. How would you characterize the environment right now that you're operating in? Consumer, credit, all of it?
Yeah, look, it's a challenging environment overall, but I think what you saw is some solid performance when you look through into the underlying, fundamentals of the business. We had strong net interest income growth driven by the higher rates and loan growth that we've seen. We had really good credit performance that's continued, for the last number of quarters across both the consumers and our commercial portfolios. We've got really good, strong capital ratios that continue there. And we've been continuing to execute on the things that we can control the most, our risk and control infrastructure build out, our efficiency program, and the products and people we need to continue to grow across each of the businesses. So good, solid performance in a really challenging macro environment.
The self-help story, as one analyst told me today, is very much intact here. You mentioned net interest income. Clearly, that's a bright spot as interest rates rise. It was up 36%. The margins were a beat as well. How sustainable do you view these kind of gains? Do you think we're at peak net interest income?
Well, I think it's hard to tell, right? The Fed's on a path to continue to increase rates. At least that's what it appears to be doing. And the market's pricing in a number of incremental rates from here. So that will certainly help. We'll continue to have to pass some of that along to customers through deposit pricing. And, we'll see how loan growth progresses for the rest of the year. But we're in an environment now where we're benefiting from higher rates, as we thought we would coming into this, given our positioning that we've done over the last couple of years.
You mentioned deposit pricing, and I wanted to hit that, too, because I know that investors are really paying attention to the outflows right now happening in deposits. Your costs were less than some of your competitors that reported today. First, I'm wondering why is that, and just how competitive you think that's going to get, the pressure to raise those prices.
Well, we certainly have different mixes of businesses, so that's probably part of some of the differences you see across the peer set. But for us, as we've said for a while now, as rates continue to rise, you're going to see deposit prices go up, and as they rise from here, those prices will go up a bit faster than you've seen so far. It'll happen most in our corporate investment bank, where those are the most price-sensitive deposits. We're also seeing that pressure in our wealth and investment management business, and a lesser degree on the core consumer side. But from here, as rates go up, you're going to see pricing definitely go up.
And you mentioned loans also growing, and we saw that across banks, although your loan growth was a little bit below consensus and quarter to quarter was flat. Why is that, and is that the end of loan growth?
Well, we thought coming into this quarter that the growth rates were going to moderate quite a bit. What we saw in the first half of the year was that really strong growth, coming out of the first quarter and into the second quarter. And we knew that just wasn't going to sustain itself across the book. But underneath that, you're seeing our credit card portfolio continue to grow. You're seeing the home lending first lien mortgages continue to grow. A little bit offset by our auto portfolio. And then you're seeing some good, stable loan balances across the other businesses. Our commercial bank continues to grow, and it's offset a little bit by what's happening in the corporate investment bank. But overall, we're about where we expected based on what we were seeing earlier in the quarter, coming out of the second quarter. And then from here, I think it's going to be dependent upon what happens in the overall economy. And I think we're not past the utilization rates in our commercial businesses aren't past where they were in the pre-COVID. So I think there's still some opportunity to grow here, but I think a lot of it will be dependent upon what happens in the environment.
Are you guys expecting a recession anytime soon?
Well, I leave the projections of whether we're going to hit a recession or not to others. But I think from what we're seeing so far, you're going to see some slowing growth as rates rise. But so far, consumers are doing really well. They're out there spending. We're seeing good, healthy activity across our commercial client base as well. And so we're not seeing the impact of that yet for sure. But, I think we're certain that the economy will slow as rates go up. But, I'll leave, timing and depth of a recession maybe to others to project. But I think we'll certainly see that slowing happen over the coming quarters.
I'd have to ask you, obviously, about the $2 billion hit. Obviously, you're still dealing with big regulatory and litigation costs. And any sense of what inning we're in here?
Well, I think, these costs are just part of the process and that we need to go through to put some of these past issues behind us. And we're working really hard to do that. We're making good progress on it. But as we've been, trying to say now for a number of quarters, we still have a lot of work to do. We're still working through that with as much urgency as we can. The costs we saw in the quarter are just reflective of the progress we continue to make in that work effort.
Investors seem to agree. Stock up 3%. Mike, thank you for joining me today.